Everybody's waiting for rates to drop. But here's the truth. The Fed, they don't care about you. They don't care about me. They don't care about whether you're a renter or a buyer. They have one job. Once you understand it, you're going to know exactly what's about to happen. And the best part is, you're going to know how to beat everybody to the punch. So let's break that down step by step. Because once you see the pattern, you'll realize it's all predictable. So in this video, we'll get into why the Fed will push up rates, the few things that can force them to back off and lower rates, and how this is all going to impact you if you're deciding to buy a house or be a lifelong renter. So here's the problem. Every time a recession hits, the Fed usually cuts rates by 3 or 4%. And guess what that does? It gets the economy moving again. The problem is, rates have been sitting closer to 0%. So every time we've hit a recession lately, there's nothing left to cut. So what's going to happen? We're going to get negative rates? Well, that hasn't worked. Go look at Europe. Go look at Japan. They tried it and it was abysmal. They're still trying to figure out what to do. Let's look at Japan. When the central bank cut rates below 0, families didn't go out and spend. They looked at their shrinking savings and there was just one thought: I better save. Because they figured out eventually this is going to end. And so they were putting money away for retirement, kids' education, medical bills. The economists were wrong. Their models were completely shot. What's even crazier, in Europe, banks started to charge people to hold their deposits. And banks were making no money on loans because the rates were so low. So guess what they did? They stopped lending. So instead of stimulating the economy, negative rates completely did the opposite. People saved, banks made less, and growth completely stopped. So that's why, coming off massive inflation with 0% rates in 2020, the Fed said, oh, we got to reverse course, pushing it up 5%. They needed to slow down inflation, which was almost at 20%. And they did. They did a good job, actually. They cut it from 20 to 9 to now we're at below 3%. But now they're kind of like in this weird room where they're like, hey, are we at equilibrium? And so should we hold the federal fund rate at 3 or 4%? The problem is, when you had 0% rates, everything went up in price. So now with the elevated rates and the higher prices, things are no longer affordable and assets are completely out of the question for the common folk. House prices are too high, mortgage rates are too high, payments are too high. The average salary isn't going to get you a house in the place that you live. And so, like, you had all this propaganda from the BLS that jobs were growing at a faster rate than my stomach after eating Sizzler's all-you-can-eat soup and salad.
And all the soup, salad, fresh fruit, pasta, and tostadas you can possibly eat.
But the economy wasn't strong because now the job revisions has come out. The numbers were all a BS. The economy isn't strong. Go ask a construction worker on the side of the road if they think the economy's strong. Growth is weak, productivity's down, inflation's still sticky. It's closer to 3% than 2%. Core PCE, the Fed's favorite measure of inflation, is at 2.9%. And here's what most people miss. The Feds don't move like this. They're very slow. They're behind the marker because they're looking at historic data to make their decision today. In 2020, the Fed was like, oh my God, we better slash rates to 0. Well, there's a bleeding pandemic. Somebody ate a bat and poisoned the entire world. The only good thing Fauci did was he scared everybody enough into getting everybody to refinance into 2% mortgages. And yeah, mortgage rates weren't 0 when the Fed fund wasn't 0 because it's built off the 10-year. And banks have to put a margin on top of that, but they were still damn close. 15-year mortgages were like at 1.75. And what they thought was the solution, the lower rate, just became the biggest problem because housing is now stuck because everybody's on a low rate. House prices exploded 40% because they printed 4 out of every $10 between 2020 and 2022. Then affordability is not going to just change. You either have to have a correction in housing or you have to have job growth to catch up. And it's like this big misconception that the Fed leads the economy. But they're not. They're not in the front position. They're in the back position. They follow it. They use historical data to make decisions in real time. They're not looking at current events and going, hey, everyone's struggling right now. Let's make a decision right now. Auto loan delinquencies are almost 7%. Let's make a change. They wait for the cracks to get so large that everything crumbles and then they react. And then they cut rates too low and the economy heats up and it causes inflation and everything goes up in price again. And then you have this massive bull run and everybody forgets about what happened and then boom, it crashes again. And they're always chasing. They're never ahead. They're never going to guide. They're always trying to react to something. Jerome Powell and all these people, they always look backwards. Janet Yellen, the former Fed chair, they always look backwards. It's like they're stuck inside their house looking out a window. And so for everyone that's like, well, what would you do? What's going to happen right now? Well, here's like the 4 indicators that the Fed is going to look at and they need to look at in lifetime. Not 6 months ago. Then you look at it right now. Job growth, job stayers is growing, meaning people that go on unemployment stay on unemployment. Very hard to find a job once you lose your job. Inflation needs to get below 2%. It's a fact. We cannot afford, our kids can't afford, and our grandkids can't afford to have inflation continue at 3 to 5 to 9 to 20%. They need to bring back the original definition of a recession, which is 2 negative quarters of GDP, or you're going to see a stock market decline. The stock market dips at 10%. Now, if it's a V-shaped recovery, it drops and it gets back up and the Fed won't react. But if it's more of a U-shape where it goes down and it continues to lag, you're going to see the Fed react real quick. And right now, we're just starting to see these cracks. The common folk has been feeling it for 2 years. But ADP, who was a private sector, reported 32,000 job losses in September. On top of that, the BLS, the Bureau of Labor Statistics, is revising all this old data. Almost 900,000, almost a million less jobs than what was reported since March. That means that the labor market has been weak this whole year and going into last year, because last year's numbers were bogus as well. So don't be surprised when you see the next jobs report and it's a negative number, and then you'll see some big revisions, and that might cause the Fed to kind of pause and analyze and say, maybe we should be giving a bigger rate cut. But man, just watch the stock market, watch crypto. If it starts to take a dip, the Fed is going to have to react. So here's what this means. Right now, affordability, it's brutal. It's hard. What used to be every 4 clients, 1 client was pre-approved. Now it's 20 clients, 1 client's pre-approved. But I'll tell you what, when the Fed cuts and the 10-year drops and mortgage rates drop, all those 19 people that were left over, they're going to try to get back in the market. It's crazy. Every 1% drop in rates, 5.5 million new buyers qualify. That's a significant number. That's 5.5 million new people you're competing with right now. And so if rates crash quickly because the economy takes a dive, guess what? It's back to bidding wars, and those investors are going to start taking up your properties. That $500,000 house, that shit's worth $600,000 in no time. So what do you got to do? How do you win? You got to prepare now. I've been a mortgage broker for 10 years. I'm one of the top mortgage brokers in the nation since 2019. Trust me, I've seen this. People who sit back and chill and say, I'm going to wait. They call me 2 years later and they say, bleep, I should have listened. I should have done it when I first applied. And it's too late, because by the time rates drop and rates are 3 and 4%, there's a line of 30 people at the open house. So if you're pre-approved, get ready to pull the trigger. If you're not and you want to see the numbers, hit us up. But you got to get your plan ready and you got to get established so that when the opportunity presents itself, you're ready. And so you let the Fed play their little game, but you need to play yours. This is chess, this ain't checkers. If you want a strategy for your situation, DM us, book a call on my Calendly. It's in our bio. I'll show you exactly what it's going to mean when rates drop 0.25%, 0.5%, 1%. Your monthly payment's going to change. It's going to drop. Your affordability is going to increase. So you don't got to guess anymore. Let's get your game plan going. And if you like more content like this, make sure to comment, like, subscribe. We're trying to get this to 1,000 followers, 1,000 subscribers. It means the world to have you help us get there.